Right, good morning, everybody. The numbers are racing up, so I think we will begin. And welcome to a very warm and sunny Harry Potter's cupboard. Have I even had to shut the blinds? So it must be spring, which makes it a great day for our update on the Spring Budget 2023. The intention was always that this was going to be face-to-face, but logistics, time, clashes on venues sort of got us to the point where we ended up doing it virtually again. No bad thing, actually. Might well end up being that it can be a bit more interactive. We obviously have the question and answer box at the top of your screen, and also a chat room in which you can post questions, thoughts as we go through the seminar. Lucy Ellis from our business development team is in the background helping me out and keeping me on the straight and narrow, but generally fairly relaxed, quite chilled about it, happy to deal with questions as we go through, and we'll see where we get to. And where we'll start is actually by reference to a film. It's a Netflix original, which most things tend to be these days, and it's called The Grey Man. Apologies for the American spelling. I know it's not how we do it over here, but The Grey Man is finally where Ryan Gosling makes up for La La Land, and he is a shadowy, covert, quiet CIA operative who all of a sudden is dragged into a complex system of drug addicts, drug sellers, everything else that goes around that dark world. And in many ways, that's how I sort of felt about Jeremy Hunt, in that if you think about him, he was parachuted in to deal with a crisis last October, November, sort of presented as the government's most skilled operative, parachuted in particularly to deal with that crisis, where at that time, the delivery and how he held himself out was actually more important than any of the content that he said. He was a safe pair of hands to settle the market. He reduced pressure on sterling. He reduced pressure on the Bank of England to prop the pound up. And he basically gave the world confidence that we as a PLC, as an entity, could pay our way. And the impact of that was quite marked. This is the FTSE 100 over 2022. And if you look on the right-hand side over here, this is mini budget time, Liz Truss time, quasi-Quartec time, where the market reaction to the mini budget and the subsequent reversals actually were very, very poor. But then you can see that as Jeremy Hunt took control, confidence returned and the market started to rise and keep rising. And obviously there was a blip towards the end of the year, but we know that in January, February, actually we got over the 8,000 mark. So a pretty strong reaction to The Grey Man, and it sort of delivered what he was intended to do at the time. And actually, it also worked in relation to sterling. I'm not overly convinced about the September 2020 to October 2024 at the bottom, but because from what I can see, this is the relationship between sterling and the US dollar. And over here, I think actually that's Truss economics. And then we see the market reaction to where Jeremy Hunt has an impact, and Rishi Sunak is appointed Prime Minister, to the point where we get to $1.14. So I think in terms of the impact of the quiet man, the grey man, it did what it sort of said on the tin. And that's where we got to in relation to the start of the budget speech, in that he explained that the recession had been avoided in 2023, I say absolutely just, double exclamation marks actually. But he then presented a picture where growth forecast of 1.8% in 2024, and then increasing to 2.5% in 2025. And then it drops off a little bit for 2026, 2027, and 2028, but generally hovering around about the 1.8, 1.92% mark, so reasonable. Inflation peaking at 11.2% in October 2022. But forecast to fall to 2.9% by the end of 2023. I know that's difficult to believe, given that this morning we understand that actually inflation rose in February, predominantly due to increase in drinks in pubs, apparently. But the expectation is that average inflation over 2023 will be about 6-point-something% and will fall to 2.9% by the end of 2023. Unemployment forecast to be 4.4%, still massively low. We used to think that a reasonable position was 7% with a target of 5%. We've been operating at 4.4% for a long, long time. So it's a near 50-year low. The problem being the sort of inequality of where things are in that, because there's been a significant increase in those neither in nor actively looking for work, and that's one of the focuses of some of the measures that the Chancellor introduced last week. Interest rates still controlled by the Bank of England. Interest rates still linked by the Bank of England to 4%, but didn't we always think that 4% would be the new normal? I'm pretty sure we did. In that, back, if you go back 2 or 3 years ago, effectively, we always said that the expectation was that interest rates would increase to 4%, and that would be the new position. And I think we're sort of getting there. Feel quite comfortable with that. And I think that, as a part of that, the pressure will now be on the Bank of England actually to not use interest rate increases as an automatic tool to impact inflation, but actually to consider, where we are in relation to the target for inflation. And I think 4% would be about right. Debt reducing by 27 billion in 27-28, with the interest burden falling as inflation falls. Our interest burden is incredibly sensitive at the moment, and any increases in inflation actually have a massive impact on our interest charge. So as inflation falls, so our interest burden will fall, and that will give us more leeway to sort of deliver some of the changes that the Chancellor announced at the time. So what did we end up with? Well, a conventional budget, if you want to call it that. I think the grey man, if we want to call Jeremy Hunt that, was relatively quiet in the period up to the budget, other than having to deal with the Silicon Valley Bank bailout, which probably he was a bit frustrated about, but relatively quiet. Delivered a conventional, largely unsurprising budget, certainly had the benefit of more headroom against the government's fiscal rules, and there was some tolerances in there, some sensitivity analysis which said he had some leeway to release things, and it made the statement, a British economy which is proving the doubters wrong. A very bold statement, not one that I'm wholly convinced about, which I'll come back to, with the priorities being to cut inflation. That helps all of us in relation to cost of living, but also, as I said, in relation to the interest burden, to boost economic growth and to incentivise investments. But the headwinds are still there, and that's why I'm sort of unconvinced that the war in Ukraine is still a massive disruptor for the world economy in relation to energy prices and also in relation to global supply chains. So the wholesale price, we're told, is falling, but energy prices are still under pressure. And I think the Chancellor dealt with that by really saying, instead of increasing the energy cap from 2,500 to 3,000, we're going to keep it at 2,500 for a longer period. So that sort of worked. Global supply chain pressures are still massive. That's what we hear a lot about from our clients. Similarly, cost of living crisis and the need for continuing support for households that are struggling. UK News this morning was on about food banks and the cost of the food banks are having to incur in getting product in there that they can then donate. Inflationary pressures still massive, exacerbated by the wage inflation and the general industrial unrest around that. And we can see bit by bit that the government is having to negotiate wage increases within the public sector, but doing it in a managed way because they're really concerned that it will flow through to additional inflationary exposure. Dare I mention Brexit? Seem to have forgotten about it, but it seems to me that the terms of trade shock is coming through to the market at the moment, and it's probably not as beneficial as we thought it was. And labour shortages in many of our key markets, we just can't find the workers there. So some difficult headwinds that sort of suggest that, it's okay, but is it really as good as the grey man made out? So what did we end up with? Well, corporation tax, lots of industry pressure on government to change their mind on this and really to continue with interest rates around about the corporation tax rates at around about the 19% mark. Government resisted this. I think there were a number of reasons. One is it would be seen as if they were effectively working towards an election and sort of trying to engender support for an election process that will start in a couple of years. But actually, I think the wider principle is that government isn't actually convinced that low corporation tax rates incentivise investment or actually increase productivity. And I think the wider picture is that they think that even at 25%, that we're still competitive compared to the other countries in the G7. So where we end up is that from the 1st of April 2023, if your profits exceed £250,000, you will now pay corporation tax at 25%. If you're in the band between 50,000 and 250,000, you will pay corporation tax at a marginal rate of 26.5% as we build up from 19 up to 25%. And then for smaller companies, if your profits are below 50,000, you'll stick at the a £50,000 mark. We've been there before. We're used to the marginal rate calculations. We're used to looking across groups to see what the profile of profits are, to making sure that we've not got one company that's paying tax at 26.5 and one company that's paying it at 19, with some space that we can equalize. And I think the biggest thing that we're working on at the moment is that up to April 2023, the definition of associated company was one effectively that you controlled, so your subsidiaries, if you want to look at it like that, but it's now going to be extended to include those that are under common control. So within your group, you might have two companies, holding company, trading subsidiary, but if you've got another company over here that's owned in the same way by the same people, then that will be treated as associated. That will impact the bands that we're talking about for the marginal rate relief calculations and the level at which you start to pay at the full rate of 25%. But it will also directly impact the bands when you start to consider quarterly installments. Are your profits at a level where you now need to pay in installments during your accounting period? And those limits, when you consider that, will now be reduced potentially by more companies than there would have been before. So we met with a client on Monday. They originally have two associated companies. So for QIPs, quarterly installments, it's 1.5 million divided by 2, so 750,000, so they're all right. Actually, post 1st of April 2023, there's 3 associated companies because they have got one sat over here. So 1.5 million divided by 3, 500,000. Actually, one of the companies then falls into quarterly installments, and that really starts to crunch the cash flow at a time where also potentially the rate's going to be higher. So that you need to review that position. So corporation tax staying as it is. Never thought actually he was going to reverse it. He was pretty cut and dried about it last November. But what he has done, he's actually made some changes to capital allowances, which we need to work through and understand. So what we knew was that the annual investment allowance threshold was going to be set permanently at £1 million. It was expected to reduce to 200,000. It's now 1 million and will stay at 1 million. And the view from government is that that covers the investment needs of 99% of UK businesses. So 99% of UK business will get 100% tax free for whatever they spend on plant and machinery. So good stuff. Super deduction goes at the end of this month, in 31st of March. And I think there was never any intention that there would be a true son of super deduction, because in reality, super deduction was all about trying to persuade people to make capital expenditure plans earlier and to spend that money in the 2-year period up to the end of March 2023. It was a timing thing, because at the end of the day, the rate of relief that you obtained against your tax bill was the same. So if you think about it, a super deduction at 130% at 19% corporation tax gives you net tax, effective tax relief of 24.7%. 100% under the annual investment allowance gives you 25% relief, which is 25% relief, effective rate. So there or thereabouts the same. So super deduction was always going to go, I think, and it was all about timing of relief. What we did get is 2 new words: full expensing. Not come across that one before. So full expensing is where you will obtain 100% first year allowance on capital expenditure from the 1st of April 2023. This is in addition to the annual investment allowance, and it is uncapped. But the fact that it's uncapped doesn't mean that it's become, by all extent, the son of super deduction. It's available on new and unused plant and machinery, not available or applicable to cars as before. I think that's quite clear. And alongside the 100% full expensing, there's then mini full expensing of 50% on special rate expenditure. So that's integral features, some cars with emissions over 50 grams per kilometre, and long life assets, and what's the other one, that thermal insulation. So a few things that you'll get 50%. I don't know. I'm not convinced on this, right? And I'll tell you why. So will it deliver? Well, firstly, it's a temporary allowance. So it's only available from the 1st of April 2023 until the April 2026, so 3-year period. 3 years, is that long enough for businesses really to plan their investment profile and their cash flow spending and to make those capital decisions? Probably don't know. Supply chain issues show that actually the lead time on getting significant plant and machinery is longer. If you order something today, you probably won't get it till 2024, possibly 2025 anyway. And if you think about it, if 99% of expenditure is already fully relieved by the annual investment allowance, what's it there for? So the way I'll explain it is, if you've got £1 million of capital expenditure, whether it's special rate or main pool, you will always, I think, claim the annual investment allowance on it, because you're going to get full 100% relief on it. The reason why you do that, rather than use full expensing, is that full expensing is almost treated as if you treat that asset as depooled. So it stands outside the pool. You have to keep records that maintain the thinking of having that out there and why. And if you sell it, you get a full balancing charge based on what you sell it for. So if it's £1 million of expenditure and you get full expensing on it, you've got £1 million worth of tax relief. But if you then sell it for £500,000, you will get a balancing charge of £500,000 in the year in which you sell it. If you claim it as the annual investment allowance, the impact of the disposal flows through the pool. So whilst the 500,000 will go as a deduction in your main pool, the impact of that is spread probably over 8 or 9 years. So why would you do it? So there's an admin burden of keeping track of it. There's balancing charges which will arise on the assets when you've disposed of them, which is not a good thing. And the way I concluded on this is it's probably only going to be of benefit to larger corporates whose capital expenditure will exceed £1 million per annum. And based on government records, that's 1% of companies in the UK. So is it going to have the impact that Jeremy Hunt thinks it will do? It's only available to corporates, so unincorporated businesses, partnerships, LLPs don't get it, but they still get AIAs. And I think AIAs probably will be the where you'll end up with this, unless you really are a large entity. The other focus of government is quite clearly to persuade businesses to innovate and to incur qualifying research and development. They see that as being a good way of increasing productivity and generating growth and wealth. The direction of travel is quite clearly that the government wants one scheme. The consultation on that ended earlier this month, and government says that it will legislate in relation to a unified scheme in April 2024. And the direction of travel is quite clearly to make sure that all the snake oil salesmen in this marketplace are out, which is a good thing, and that the quality and nature of claims are robust and supported and flow in a unified scheme. So in relation to the snake oil salesman, obviously pressure is on government to make sure they're out the marketplace. One measure that will directly enable that in one way is that from 1st of August 2023, you will now have to supply supporting documentation with all R&D claims. Now, and that's never been a problem for us, because we've always done detailed reports behind an R&D claim, which sets out, how have we focused on the 4 questions, the 4 pillars of R&D, and what is the uncertainty we're trying to solve. But the snake oil salesmen are just basically coming up with a proportion or a figure, putting it into returns, making a claim, hoping that they're flowing under the radar, and that the repayments are flowing to their either the company themselves or the client. It's a good change, and it's one that we welcome. The squeezing of the 2 schemes was announced in November, in the small scheme, the SME scheme, the enhancement for qualifying expenditure is reduced from 130% to 86%. So that's quite a major reduction when you think that government's sort of trying to persuade people to undertake this expenditure. The relief, obviously, from 1st of April will be given a better rate, 25% rather than 19%. But it does mean that the rate of relief for an SME will reduce from 33% to 18.6%. So it's not as beneficial as it used to be. But I think that's a forerunner to the unified scheme, because alongside that, The RDEX scheme for large company, actually, the relief has been increased to 15% from 10.53%. So a large company is actually getting better relief. I think that will really suit the sort of farmer companies around that. But there was a further change, which is a bit frustrating, because you never like legislation to be introduced in a piecemeal fashion, which again leads to an element of uncertainty and an inability to plan when and how things are going to happen. But there was a slight reversal of the SME reductions introduced last November, and it refers specifically to companies that are loss-making and are what are known as R&D intensive. And R&D intensive is defined as being where more than 40% of your total expenditure is on R&D activity. So again, probably technology, pharma, those sort of companies. And where that's the case, the rate of relief is increased to 27 pence effective rate. So over the last 6 months, the relief has fluctuated from a very generous 33,350 for every £100,000 of the qualifying expenditure, down to 18,600, which is a bit obtuse given that we're trying to persuade people to do it. But there will be an opportunity for R&D intensive companies to increase that to 26,970. So you need to get to grips with the rules, and where previously you were an SME and you've made significant claims, there will be now an impact on how much cash you're actually going to get back, which you'll need to factor into your cash flows. Again, a bit unhappy about the lack of uncertainty around this. Right. Well, just before we nip on to the next bit, rates and allowance, there's a great question from Keith in the chat room, which is effectively, if a company makes £400,000 worth of profit, what is the tax calculation? So it's if you've got an accounting period that straddles the 1st of April 2023, then effectively you're going to have to do a tax return which straddles that period. So if it's a 30th of September year end, then you've got 6 months under old rates, 6 months under new rate. So 200,000 of Keith's profits will be taxed at 19%, and then 200,000 of Keith's profits will now be taxed at the new rate. 200,000 for 6 months means that actually at that level the company is over the £250,000 limit, and so therefore all of those 200,000 will now be taxed at 25%. If the figures were less, and let's say it was profits of 100,000, then 50,000 would be taxed in at 25% in the last 6 month period. That would be in the marginal band. And so the way the calculation works is it effectively taxes it all initially at 25%, but then there's some marginal relief that reduces that rate down depending upon how far up the band it is. So it'll be something like 26.5% on those profits. Most software will handle it. It's back to the rules probably about 10 years ago. It's an interesting one to play around with. But good question, Keith, thank you. Rates and allowances, an aid memoir here really, because it influences a lot of the thinking around remuneration planning that I'm going to come on to in a moment. So income tax and national insurance thresholds are actually frozen until April 2028. Element of stealth tax in that. So as inflation means that wages go up, then automatically more people will be paying more tax at those higher rates. The inheritance tax threshold is frozen also until April 2028. And the additional rate threshold is reduced to 125,140 from April 2023. So we sort of knew all of this was coming. The tax-free dividend threshold is reduced to £1,000, so halved from 1st of April 2023, and reduced to £500 from April 2024. So the amount you can receive as a tax-free dividend is reduced. And then finally, the annual CGT exemption is halved to 6,000 from April 2023, and then halved again the year after. So the tax-free elements are being challenged, whilst at the same time the thresholds are being frozen. So you're sort of pitching up at more income taxable and potentially at higher rates, which brings it nicely to the final bit on rates, which is, I think we all heard the furore about national insurance contributions and health and social care levy last year. All of that's been abolished and removed, but actually there's no such reduction for dividend income. So for a basic rate taxpayer from 5th of April 2023, The rate of tax on dividends above the tax-free element is 8.75%. A higher rate individual is 33.75%. An additional rate individual is 39.35%. Which brings me nicely to probably the best slide since sliced bread, and probably the question we've been asked most over the last week or so. This is a calculation of the effective rate of tax by withdrawing your money out of a limited company. At the top, you'll see that it refers to the different levels of company profits, and on the left, it refers to whether you're a basic rate, a higher rate, or an additional rate taxpayer. Within this, pensions will always win, actually. So a company pension contribution will scupper all of this, and obviously we're going to come on to pensions in a moment, but this is purely a comparison between dividends and salaries. In order to make the comparison able to work, the cost of the company has been fixed at £1,000. So whichever way you take your money out, the cost of the company will be £1,000. Green says it's a good thing, red says it's a bad thing. So if your company profits are up to £50,000, and you withdraw your £1,000 out by way of a dividend, then effectively you will be paying tax at basic rate at 8.75%. If you were to take the same route by way of a salary, it would be 26.23%. So quite clearly, in those circumstances, you would be best to take your money out by way of dividend. If you, however, have a company that's in the marginal rate band, so the 50,000 to 250,000 mark, then the analysis changes slightly. Because if you go to somebody who is a higher rate taxpayer, then that £1,000 actually suffers in a dividend route 33.75% tax. But if you were to withdraw it by way of a bonus or salary, actually the effective rate of tax falls to 30.66%. And that's because of the benefit of the marginal rate of corporation tax, the relief on that bonus. So actually you'd be better off taking that money out by way of a salary or bonus. And you can work through it on sort of all sort of levels. So if you go to a very profitable company that's paying tax wholly at 25%, then if you've got a basic rate taxpayer, yeah, they're still best to take it out by way of a dividend because they'll only pay 8.75%. But if you were a higher rate or additional rate taxpayer, then actually you will always be better off taking it out by way of bonus or salary. And I think that's going to be a sea change on remuneration planning, because generally the focus for most individuals has been pension contribution first. That always works best. But once you've got over that, then it's been the idea that you take a small salary that's able to meet your national insurance contribution requirements. So lower earnings level gives you the big tick in the state pension box, and then anything above that withdraw by way of dividend. This analysis here suggests that that's changing. And so where you've got individuals that are looking to withdraw value, you need to have that conversation either with your client or with the individual that says, have you thought about taking it out by way of bonus? Because it's a cheaper way of doing it. But great slide, and thanks for the team for pulling that together, because I think that's going to be a reference point for us for the next couple of years as we work through a lot of these questions. Okay, right. Alongside remuneration, and this has been used quite a lot over the pandemic, and certainly has become more prevalent with senior management, is sort of cashless remuneration in the form of share options. And the government approved scheme is the Enterprise Management Incentive Scheme. And has worked fantastically, been there a long time, has delivered real value to senior management. You know, they've been able to be granted options at a time when the company has very little value, and to exercise those options on exit where, you know, they've created value and been able to participate in it and pay capital gains tax on their proceeds at usually a rate of 10%. And the governments, I think, around that are quite keen to see this promoted further. And so in doing that, they want to simplify the process of granting those options. So at the moment, the provisions say that if there are any share restrictions in relation to the shares over which options are being granted, then you need to refer to that specifically into the option agreement. And if it's not in there, then it's an invalid option agreement, even though it might be sort of expressed somewhere else. From April 2023, there will be no need to include details of those share restrictions within the annual option agreement. Similarly, from April 2023, the requirement for the company to show that the employee has signed a working time declaration will be removed. there is a condition that the individual to which option have been granted has to be a full-time working employee. And usually within the option agreements we deal with, there is a declaration that's signed at the back of that agreement, which confirms from the employee that they are. They are if they are, I think. And so government has said, well, actually, there's no point having that declaration in there. Let's take that out. Let's make the option agreement simpler. The thing that sort of comes up a lot in due diligence and is probably the biggest risk on EMI options is the fact that you need to register the scheme with the revenue and also notify the granting of options to HMRC within a very, very finite deadline, and that's 92 days. And if you meet your 92 days, if you miss your 92 days, I can think of very, 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 very few circumstances where you get a reasonable excuse for missing that deadline. Government sort of recognise that, and what they've said is, we're happy for you to notify us of the grant of options, not within 92 days, but now by 6th of July, following the end of the tax year within which the option is granted. And I think that's a sensible approach, because actually that's the date by which you have to do your annual EMI option return, EMI scheme return. So it sort of aligns everything. And actually most sort of post-tax year returns now have to be done by the 6th of July. So that's a welcome change and sort of reflects government's objective to make it easier to grant EMI options to key individuals, to incentivise and retain them, and not to make it a stick that becomes a sort of an admin burden that if you fall foul of, you've destroyed the benefit of it. Okay, this was the sort of big stuff now. And I suppose there's two issues with this. One is industry pressure from the NHS in relation to doctors who were getting to the point where actually it wasn't worth them taking on additional roles and responsibilities or continuing to work, because actually in doing so, all they ever did was suffer a pension tax charge because they were in excess of the annual allowance. So from 6th of April 2023, the annual allowance will be increased from 40,000 to 60,000. And then similarly, the point at which it starts to taper will now be increased to 260,000. It was 240, and the minimum it will be reduced to is 10,000. So an increase in the annual allowance, you can still use the preceding 3 years on relief, and then the tapering amount is 10,000 rather than 4. And the expectation is that these measures will prevent over 80% of NHS doctors from receiving a tax charge. Seems like good stuff to me. Whether it delivers what it's intended to, time will tell. But the market reaction was pretty good. Alongside that, there's obviously been a lot of media speculation about this view that people are retiring too early, and we're losing a skilled generation too early, and that's impacting on the productivity gap and resource issues. So alongside that, the lifetime allowance charge has been removed. So from 6th of April 2023, that's removed. It would previously be pretty punitive at 55% of the excess. So, it was extremely expensive. And the intention is that at a future fiscal event, which might well be next year's budget or the one after, the government will legislate to remove the lifetime allowance from the legislation totally. So there won't be a cap on what your pension fund can look like, and it can keep going. And the view on that is that that will persuade people to come back to work, because they can still sort of earn money, put money into their pension, build up a pot that they can pass on to their family tax efficiently. The sting in the tail is that the tax-free lump sum that you can take out is fixed at 25% of the current lifetime allowance. So it's fixed at 268,275. Those with a protected right, so those who have previously agreed that their lifetime allowance is at a higher level, will continue to be able to take out 25% of the protected level. But for the majority of us who are coming through, majority of people that have sensibly invested in pensions other than me, will be 268,275. Where amounts in excess of the tax-free amount are taken, so if you take more than 268, 275 out, then this will now be taxed at an individual's marginal tax rate, it's whatever your higher rate is, rather than the punitive rate of 55%. So we're really continuing still to have ultimate pension flexibility, the ability to put as much as you want in, to be able to get higher rate tax free for what you put in, to build up a pension pot that now doesn't get a cap and a punitive tax charge, and actually it becomes the sort of IHT planning golden egg that you can pass on to your next generation. So yeah, definitely there's some good measures there, and really appreciated by the market. Great word, miscellany. Although the only picture I could pick that linked to that was Jeremy Beadle's Miscellany, and Jeremy Beadle, as a child growing up in the UK, was somebody that I absolutely hated, but it was the only the picture I could find. So a miscellany of what else was in the budget. Capital gains tax on divorce or separations. Couples will now have 3 years after the year in which they cease to live together to transfer assets at no gain, no loss. So generally, it's been very sort of tight deadline. If you've got contentious divorce proceedings, it takes a lot longer than the current limit, which is 1 year following the year of separation. And so you're now in a position where you've got 3 years to sort that out. The VAT registration threshold frozen until 31st of March 2024. We knew that, but it does mean that more companies will be going over the 85,000. Making tax digital deferred. I say deferred, it's definitely coming. But the basis period reform continues from April 2023. And this is where government is trying to persuade everybody to have a year end that aligns with the tax year end. They did it years ago back in self-assessment day 96, 97. So they're having another crack at it. And the idea is that you can either change your year end and then have a transition of how you get there, or you can have a different year end to the tax year end. And if you do, then you're going to have to prepare effectively provisional accounts that tie into the tax year. So a bit of a pain in the neck. 100% capital allowances on electric vehicle charge points extended to the 31st of March 2025. So still an objective to persuade more people to go electric, and in doing so, you'll get 100% tax relief on putting the electric charge point in. And then enterprise zone confirmed, including South Yorkshire, which we're told will have £80 million of possible interventions over the next 5 years. So you would hope that would see some significant benefits flow into the right place and the right time. So a conventional budget, I think conventional also, I didn't make the point at the time, but because government had quite clearly said that any significant tax changes should happen not in the spring budget, but actually in the autumn budget, because in doing that, it sits very closely to the income and expenditure plans of government, and also gives individuals time to plan for what's going to happen when the tax year changes. So moving away from this idea that something's announced on the 16th of March and then you've got sort of either no time to deal with it or a very short period. So a relatively quiet budget. I suppose I picture Jeremy Hunt as the grey man. I think we've got two grey men, actually. I think Rishi Sunak is also a grey man. And I think it's the greyness that has allowed us to sort of get to a point where there's some stability and process that seems to mean we're making some forward progress rather than just sort of reacting to things. The slide shows Rishi Sunak riding on Jeremy Hunt's coattails and sort of suggests that we're winning. Based on the economic data, probably we are just about at the moment, but the headwinds are still there. What made me really laugh at the end was there is a part in the budget about the midlife MOT. And this is a government initiative which will hopefully see an additional 40,000 people have sort of a digital financial MOT, which makes sure they're going in the right direction at the right time, heading to retirement. I don't know about midlife MOT, but having survived a pandemic and then everything else that's happened, I just don't need a midlife MOT. I need a new carburetor, change of exhaust, and probably a couple of oil filter changes, because I feel pretty battered at the moment. And that's an end to it. Couldn't make it longer because actually there wasn't much else in there. So thank you for joining me. Good question from Chris Marshall. Will the increase in the pensions allowance increase the cost to companies for staff earning over 40k? Don't know the answer to that one, Chris, actually. I mean, obviously, pensions allowance will enable companies to make additional pension contributions for those staff. They will get higher rate, they will get corporate tax relief for it at a higher rate. I think you'd need to do the mathematics on it. Email me directly and I'll put some examples together for you. I'm not sure off the top, not really thought that one through. Other than that, I think it's probably time for us to go out and enjoy the sunshine and get back to work. There is a survey that Lucy will be circulating, which sort of says, is online better than better than face-to-face? What else do you want to see? Does it sort of work for you? So happy for any feedback that you've got on that. Other than that, thank you very much for your time. Hope to see you face-to-face soon, and thank you.